The age of alignment. Good afternoon. I'm Richard Gigline, and I'd like to welcome you to the latest in our Compensation Committee webinar series titled Age of Alignment, Linking Compensation and Business Strategy. We've entered a new era with evolving responsibilities for the Board of Directors. Today, the review and concur role is no longer sufficient. This is true from a regulatory and compliance perspective, and it is also true as companies must be prepared for the challenge of fast, frequent, and often disruptive market forces. Recently, the NACD released its Blue Ribbon Commission report on strategy development. Among many important findings and recommendations, it states that providing necessary strategic direction requires a new level of ongoing board engagement. A key question posed for boards to evaluate their processes is, does our incentive structure reinforce or unintentionally undermine the chosen strategy? Today, our discussion will be led by two members of the Blue Ribbon Commission, Greg Lau of RSR Partners and a member of the board of NACD, as well as Stephen Van Patten, Managing Director and Office Head from Perlmeyer & Partners Boston location. We will also be joined by consultant Michael Ng from Perlmeyer & Partners. Before we begin, let me turn it over to Rennell Perry with NACD's education team for a few housekeeping announcements. Rennell?
Thank you, Richard. If at any time during the live presentation you would like to ask a question to our experts, feel free to submit your questions and comments below. Also, you can access additional resources by clicking on the buttons below. Click Download Presentation for a copy of the slides. Slides will be available at perlmeyer.com/Age of Alignment next week. Also, you will receive one skill-specific credit to use for NACD fellowships. You can contact the email address on the screen for more information. Again, a replay of the slides will be available early next week on nacdonline.org/webinars and perlmeyer.com. Richard, back to you.
I think with that, we will begin the body of the presentation.
Okay, this is Greg Lau on Chart 6. Again, welcome to this session on linking compensation and business strategy. We will be focusing today on the questions you see on the chart. What should the role of the board be as it relates to corporate strategy? Why is it important to link pay and strategy? The hallmarks of a strategically aligned pay program. Some approaches for developing strategically aligned pay programs. What methods can directors use to evaluate the degree to which current or proposed pay programs are aligned with strategy? And finally, how does the board ensure ongoing alignment of pay and strategy? So let's discuss the first question, turning to Chart 7. In October, as Richard said, at NACD's National Conference, we released the Blue Ribbon Commission report on strategy development. I will briefly summarize it, but I encourage members to download the report. It's free on the NACD website. The role of the board in the strategic process can have two spectrums. One is the directors are too hands-off, so they may fail to fully understand the options and risks and the assumptions within the strategic plan. Or they're too far on the other side with crossing over the line into oversight into management, which can undermine the board's ability to hold management accountable. So the board needs to seek the right balance, and the lead director or the independent chair and the CEO need to be sure of this balance. It's optimal engagement by both parties, with management still having the primary responsibility, but engaging the board's collective perspective and expertise in the process. Let's turn to Chart 8. These are the 10 recommendations from the report. The Blue Ribbon Commission recognized the effective disruptive market forces have on strategy. a comment today would be seeing where the oil price is falling, and if oil was part of your assumptions, let's say at $100 a barrel, you should take a look at your strategy. So this raises the bar in frequency and degree of board involvement on a continual basis. It leverages the entire board's experience and expertise. Every director participates with management, and it fosters an open and candid relationship with management. So it should be a win-win. I've shown here in red some of the key implications of the recommendations. So it's number 1, 5, 8, and 10. And these are the direct implications on our topic on compensation as a critical role in strategy. So let me now turn it over to Steve, and he will get into the specifics.
Great, thanks, Greg. This is Steve Van Putten from Pearl Meyer. If we turn the slide to number 9, as the BRC report states, corporate strategy must adapt to accelerating change in an increasingly uncertain environment. Compensation programs, too, must also adapt to change and uncertainty, and it has to do so at the same pace that your strategy adapts as well. In fact, to the extent that your compensation program does not evolve to support your business strategy, it could actually end up undermining your strategy because you'll have incentives in place that could encourage actions, behaviors, and outcomes that are actually inconsistent with or even counter to your chosen business strategy. And in that context, I often see two classic mistakes that companies make. First, their compensation programs are essentially on autopilot. They have an existing structure that's been in place for a number of years, same metrics, same payout slopes, same participation, and it creates stagnation to the programs, and it doesn't adapt, nor does it signal changes in the company's strategic priorities. The second mistake we see that compensations are solely market-derived, what we call Me Too compensation program designs, that essentially you follow what the market practice would dictate. In both cases, I believe there's an opportunity for the board to be more actively engaged in ensuring pay and strategy alignment. So if we look at this slide, number 9, you can see that in a recent Pearl Meyer survey, it identifies that aligning incentives with business strategy is the greatest pay-related challenge for 2015. I think it also reflects the greatest opportunity for boards and senior management. An opportunity not only enabling your company to attract and retain the best talent, but also to use pay as a catalyst for achieving competitive advantage. I think we need to change how we view compensation. Traditionally, compensation is viewed as a cost. It really should be viewed as an investment. In order to maximize return on your compensation investment, you need to make sure you invest those dollars in a way that maximizes returns. And that's what we're going to speak to during the bulk of this presentation. Going forward to the next slide, at its fundamental core, compensation is a signal, principally among employees, but also to other stakeholders as to what the organization views as important. Essentially, with your compensation program design, you're messaging to employees what your strategic priorities are. For publicly traded companies, you're also messaging that externally because you have disclosures in your annual shareholder proxy statement. By linking pay and strategy, you're letting employees know what is important, but also enables them to understand what the organization is trying to accomplish. And as employees better understand what it is you're trying to accomplish, that leads to greater acceptance among employees. Hence, you create a virtuous circle of continuous improvement. Go to the next slide. As we begin to think about how to align pay programs with business strategy, and we're going to spend a good bit of time talking about that, I also think it is important to keep in mind that developing a business strategy inevitably involves prioritization and trade-offs. You can't necessarily accomplish everything with your business strategy. So you do have to focus on certain strategic priorities, ultimately that you hope leads to value creation. I know that when we work with our clients at Pearl Meyer, we often use a simple value driver tree to help us understand what their chosen strategy is. We'll set up a model, but we'll ask the client to help us populate what are the key drivers. And that extends all the way from the top, where ultimately it's usually some combination of growth and returns, all the way down to lower level branches that identify the key drivers of value realization. We can then evaluate the degree to which pay programs are currently aligned with and supportive of that business strategy. Essentially, you map your current program design to this value driver analysis to see whether the two are connected with good overlap. A second benefit from a value driver analysis is that it can assist with ensuring vertical alignment of incentives, because ultimately a value driver analysis identifies goals that are cascaded down lower into the organization. So if we look at this simple sample value driver analysis for illustration, you can see that value creation can be driven by revenue growth, which in turn can be driven by new product design, which in turn can be driven by innovation. That can then permeate and cascade goals all the way down into the organization. It can also ensure that those lower level goals are aligned with the higher level objectives. Let's go to the next slide. I'm going to speak a little bit about some of the hallmarks that we see in strategically aligned pay programs. Ultimately, we think that strategically aligned pay programs exhibit a balance on a number of different perspectives. I think if you look at the visual on the right-hand side, what you try to see is a balance between driver metrics and outcome metrics, and I'll explain those, and metrics that support alignment versus accountability. I think in most incentive program designs that exist today in today's environment, the weight is more shifted towards the right. They're more focused on outcome metrics and accountability for results. So outcome metrics would be things like financial results, relative TSR performance, and metrics like that. Whereas driver metrics, those often reflect the strategic imperatives that will drive future value creation. And those types of metrics could include new market penetration, new products, new geographies, strategic alliances and the success in those alliances, customer satisfaction. Some of those metrics can actually be at odds with financial metrics since they involve investment expense, and that can bring down profitability. But they will spur future growth and profitability. I think one of the things that we often see with companies in their incentive plan design is that they achieve growth predominantly through financial engineering techniques. Think about the prevalence of EPS as a metric. Oftentimes that goal is attained predominantly through the use of share buybacks as opposed to reinvestment for future growth. The second dynamic is the balance of alignment and accountability. That's on the bottom right-hand side of that graphic. I mentioned overweighting accountability. A classic example of that is relative TSR, which is the most prevalent metric in long-term incentive programs. Not that there's necessarily an issue with relative TSR, but it's having the right perspective on it. I think where it's used most effectively, relative TSR can be an effective check and balance on internally set goals. But I don't tend to like to see it as a sole metric in the long-term incentive program. Another example would be individual bonuses at lower levels that are determined solely on the basis of company financial performance. There, I think you lose alignment and line of sight to what is within an individual employee's sphere of influence or control. The third element considers both the what and the how. I think companies, for the most part, do a good job of measuring the what. Those are the measurable and easily determinable outcomes from an incentive program. But I think it's also important to consider how those results were attained. And one way you can do that is actually to use discretion. And I know that can sometimes be a challenging approach for many companies, but I think it also can be very helpful. And discretion, when I say that, I mean both ways. You can use discretion up and you can use discretion that's down. At the end of the day, strategic aligned pay programs recognizes that performance cannot solely be captured in a performance metric, and companies should consider using discretion, informed discretion, as a way to determine incentive payouts under their programs. And I'll speak a little bit more about that later. Okay, just moving to the next slide. When Pearl Meyer views the developing strategically aligned pay programs, we often work with companies closely, and typically in our role as advisors to compensation committees and senior management, the first question we often get asked is, are our programs market competitive? Are they consistent with the marketplace and what other companies do? And the second question, sometimes it's the first, do you foresee any issues with our program design with respect to how ISS or Glass Lewis shareholder advisory firms would look at our program? And I'm not to say that those are not important considerations, but it's how those considerations are used in determining compensation program design. Our view on it is that it should inform program design, but not necessarily dictate how a compensation program should be structured. Rather, we believe that business strategy and leadership strategy should be the key drivers of compensation philosophy, which in turn drive program design and then get delivered in terms of results. At the same time, market practices, optics, pay and performance alignment, those should all inform your design but not drive it. We do speak a lot about this, about business strategy in this presentation. I know, Greg, you had a particular, some thoughts around leadership strategy as it relates to the role of talent management. Did you want to mention that?
Yeah, well, thank you, Steve. Yeah, on the leadership, last year, NACD put out another Blue Ribbon Commission report called Talent Development, a Boardroom Imperative. Again, you can download it, but it really emphasizes, just like we're doing here in strategy, that talent development is a continuous process. It's not a 1 3-hour meeting of the board once a year. It should be continuous. It should be a lot of time, because in order to execute the strategy, you need the talent. If you don't, you got to figure out how you're going to get it. So it's, I think leadership is and driving it is a crucial. And what Steve said there on informing program design, I think that distinction is critical, because a lot of companies, a lot of boards, we want to be market competitive. We follow the proxy advisors, but that doesn't, in the context, that it's good to know that, but you really need to drive the strategy, and sometimes that's being different. It's being your own plan, and we have to get more comfortable with that.
Right, and to that point, Greg, actually, I'm going to share with you a couple concepts in practice. The first one's in the bottom right-hand side of that same slide, and that's this whole concept of conscious deviation from market norms, which is just the point Greg just made. So rather than mimic market practices, which at best are going to result in market average performance, why not consider consciously deviating or separating yourself from the market norms? And that can extend from how you look at peer groups, looking at reference groups as opposed to traditional peer groups, outside your space, looking at how peer companies from that perspective, and also to the design of your program. I have a client that uses a very unique program design where they have a self-adjusting payout slope in their short-term incentive program, in which the goals are automatically adjusted in relation to sales volumes. It's a very unique aspect. It's not something you normally see, but it also makes sense given a highly cyclical business that they operate in that's subject to external macroeconomic forces. By having that self-adjusting mechanism, it ensures there's a continual stretch goal in place to work toward. So goals will ratchet up during robust periods, so it doesn't result in windfall payouts. You need to stretch your performance. And then during more challenging times, the goals automatically ratchet down in relation to sales volumes to create a continual stretch objective without necessarily just resulting in a layup attainment. Another example is I have a client on the opposite end of the spectrum that uses an entirely discretion-based short-term incentive program. And so you may say, well, how can you align that with strategy? You're not communicating, sending messages. Well, they do it in a very informed way. At the beginning of the year, they set and establish key strategic priorities and imperatives around those strategic priorities. And the expectation is they're going to be held accountable against those at the end of the year. But recognizing that there is variability and volatility to how they pursue those performance outcomes. So it takes into consideration the context, the how those performance results were attained at the end of the year, along with those actual performance results. And they look at that both relative and on an absolute basis at the end of the year. Those are just a couple examples. There are a variety of examples out there where you can deviate from market practice to help your organization accomplish a particular objective. Okay, if we move to, actually, I think we're going to pick up with a polling question that's related to those comments that I just made. So if we could put that polling question up. So how closely are your pay plans aligned with market practice or business practice? Often, could be a combination, but we give a kind of a spectrum of potential answers here. It could be pretty much all market practice or mostly market practice, and that is you set your programs based on what the market does. It could be an even balance between the two, or it could really be predominantly based on your internal business strategy and to the extreme where it's without regard to what the market does. So let's just take a little bit to give folks a chance to respond to that particular question. My perspective is I think that organizations are actually doing a better job of considering business strategy. It was identified as the top key important consideration on a go-forward basis. But at the same time, I think market practice directors view that as important as well. So can we see where that ended up?
Yeah.
Yeah,
well,
okay.
Interesting.
Greg, what do you make of that?
Well, I think it's good. I think it reinforces what you said, that we're moving toward mostly business strategy. I think that's terrific. All business strategy is a tough one, but I think, with business strategy and the metrics, and you have forward-looking metrics, you can test your strategy and right away if it's working. So I think it's a good outcome.
Yeah, and that also lends itself to what we talked about earlier, having it be a very dynamic compensation program that can evolve and change and adapt as your business strategy adapts, rather than being just closely linked to what the market is doing. So I think that's healthy to see.
Yeah,
a fair number of companies use balance as well.
Yeah, I agree. I think there's a tendency to spend a lot of time on a plan and then hold it. Keep the metrics, as you were saying, Steve. Keep the metrics, keep the design, and you've got to constantly test it against the changes in strategy, because strategy doesn't remain anymore. And that's part of our report. It's constantly changing. So.
And I think that presents a great opportunity for directors and compensation committee members, as they attend and participate in full board meetings where strategy is discussed, to go back to the comp committee meeting room and revisit the pay programs. Do they still remain aligned with where we're going from a strategic standpoint? And are they reinforcing and motivating the right types of behaviors, actions, and outcomes that are going to support the realization of our strategy? Behaviors and actions are those lead type items that are going to drive future value, and then the outcomes are more the lag type metrics, and making sure there's a good balance between the two.
Yeah, and agreed. And I think in the environment of greater activism, it's even more important to do that.
Good point. Okay, why don't we move forward? Share a second concept in practice. And this is around, we talked a little bit earlier about the use of value drivers and a value driver tree. How can you incorporate that into your incentive program design? And so one concept and one way to do that is through more of a balanced scorecard type of an approach. Remember that value drivers are comprised of lead metrics. So those are the ones that drive value creation in the future. If you think about lead versus lag, lead metrics tend to be about future value creation. It could be reflected in value of products that have not yet been designed or markets that have not yet been entered, whereas lag metrics reflect success on existing products and services and maximizing growth and profitability out of them. So to the extent that you really want to reinforce and motivate lead metrics, one way to do that is through a balanced scorecard. And this can be used at all levels in the organization. We tend to see this used for either merit or bonus determination. A scorecard also gives you the flexibility to weight different elements to reflect the key strategic priority and or individual line of sight. So if you're in a particular functional area, say in finance, maybe you have a greater weight on finance. Yet at the same time, we're trying to promote teamwork, collaboration, cross-functional connections. So that individual in finance should still have a weight on customer or process or talent and technology, but just maybe not to the same extent someone would, say, in sales from a similar weight. So you can vary the weights based on ability to impact results. But this could be a helpful tool for helping companies align their compensation programs with their desired strategic outcomes. As I mentioned, it can be used all the way up the organization. You can actually roll these scorecards up by functional area all the way into the organization. One of the things to be careful of, obviously, well, two things. One is avoid over-measurement. You don't want to have too many goals because then that dilutes the effectiveness of any one goal. And also, you need to make sure that you have a reasonably robust performance management system in place that can be able to handle this type of tool. But it's something an organization can work to and evolve toward, and I think it can be an effective way to reinforce the alignment of compensation and business strategy. Another concept, this one more on the longer term incentive side of things, if we turn to the next slide. This is the objective of balancing line of sight and accountability in a long-term incentive program. I think traditionally we think of long-term incentives as more about accountability for results, typically shareholder value creation, but it can also play a key role in motivating a line and rewarding line of sight. In this example, we have an organization that uses three long-term, it's a publicly traded company that uses three long-term incentive vehicles, each of which achieves specific goals. And the vehicle eligibility varies, as you can see in this table, based on the ability to influence results. So if you look at the senior leadership team, they're the only ones that participate in stock options. And the view there is that ultimately stock options are about shareholder alignment. And senior leadership only benefits under that program to the extent that shareholders benefit. Senior leadership also has the greatest line of sight towards influencing and impacting stock price, and hence they're the only ones that participate in that program. Performance shares, though, extend a little bit more broadly and include both senior leadership and management. And this is intended to drive accountability for results. The performance shares are based on lag metrics, so EPS growth and relative TSR, which are good complementary metrics in a performance share unit program. Participation is a little bit more broad in that management can help influence EPS growth as opposed to when we looked at senior management just influencing stock price performance. And then we see restricted shares as a component. Folks often consider restricted shares as purely a retention type vehicle without any performance conditions. But in this case, this company flexes the number of restricted shares that are awarded based on the attainment of lead metrics. So they start with an established pool of restricted shares based on market level, but then they adjust the number of shares that are awarded by team and by individual based on key strategic value drivers, those lead metrics. So for example, the CEO has specific metrics around succession planning and new market sales in different geographies, and that flexed the number of shares that she was able to earn from a restricted stock program. So across that spectrum of the three vehicles, you're able to accomplish multiple objectives, both in terms of line of sight of an accountability and also lead and lag metric orientation. Those are the four key metrics that we discussed earlier in the presentation.
Yes, Steve, I would add there, especially on the other participants, is that these three programs, and certainly performance shares and restricted stock, allow management to fully communicate to the employees in order so they embrace the new or altered strategy. Very important to communicate the strategy to everybody continuously.
And that's great. And I think, Greg, you mentioned an important point in that communication. And I think as directors, I think it's also helpful to understand, because oftentimes you approve the programs and you're not exactly sure how they end up playing out or received and whether or not they're successful. So I think it's important to hear back from management how folks, are they understanding the programs? Do they recognize the value and the alignment with strategy? Get some real-time feedback from management on the efficacy of the programs. So we're going to do another slide, another poll, and this is reflective of some of the things we've just been talking about. When you think about long-term incentive programs and to what extent they're aligned with performance, you can define performance in different ways. One would just be you just use full value shares or stock options, and there's no direct financial or strategic type performance metric associated with them. Others are based on financial metrics. I talked about EPS, or they could be stock price performance, relative TSR, or they could be more strategic in nature, where they're linked to non-financial and strategic performance, or some combination of the two. So we just wanted to get a sense from our audience as to how and to what extent their company's long-term incentive plans are linked with performance. So if you wouldn't mind submitting a response to that, and we can see what that looks like. I don't know if I have any predictions on where this one.
Yeah, and I would say on using all these vehicles, the time frame that you want to achieve your strategy is important to understand as you line them up in the long-term incentive plans.
Greg, you raised a great point there. And where you tend to see the driver metrics, more of those lead metrics, they tend to be shorter metrics. 1 year is a default, but it could also be a shorter period of time than that, because those tend to be immediate strategic priorities of the organization. But at the end of the day, you want them to translate in results, whether it be sustainable revenue growth, returns on invested capital. So the expectation is from, in terms of the outcomes, that those are best measured over a longer period of time, and that could be 3 to 5 years. So let's see where we ended up from a response standpoint.
There we go.
Well, we have a good audience.
We do. About 55%, they're linked to both financial and strategic performance.
That's good, and because that reflects both those outcome and those lead metrics. I think that gives you good balance. It helps reinforce the business strategy of the organization. I think, as you said, Greg, the key thing around that, to the extent you already have it in place, is to make sure that folks really understand it, that the communication's there, and that once their payouts are generated from the programs, that you reinforce the strategy at the time you deliver messages around those payouts. So that's good to see.
Yep,
okay, so we're gonna make a little bit of a turn in our presentation. So this is what I was just speaking to is more about from a go-forward design standpoint and the role that board can play in ensuring on a go-forward basis that programs are aligned with and supportive of the company's strategy. Now we're just going to take a little bit of a tactical turn to focus just from a practical standpoint on how boards can evaluate and directors can evaluate the degree to which your current compensation programs are aligned with and supportive of business strategy. So I'm going to turn this to my colleague Mike Ng.
Hi everybody. Thanks, Steve. I just wanted to start by saying and just reiterating that good judgment will always play a key role in the decisions that you make and the distinctive advice that you give with respect to executive pay. But as you examine executive compensation for your company, it's helpful to temper that judgment with data-driven insight. And there are ways to do this methodically, quantitatively. The following 3 slides describe 3 types of analyses that can help you do this. Think of these analyses as additional tools in your governance toolbox, ways to pressure test or validate the link between compensation and strategy. Now, on the right, we've listed the 3 analyses that we're going to quickly cover: metrics correlation, probability of achievement, and pay for performance. And each of these plays a critical role in understanding pay and strategy alignment. So let's move to the next slide. Now, I guess before we dive into the analyses, it's helpful to think about the link between business strategy and pay as having more than one component. Interim steps. We start with strategy, new market entry, new products, M&A, or whatever. And then what follows is achievement or performance against these strategic goals. Then measurement, and then implications on pay. The first analysis here is intended to measure the link between strategic imperatives and outcome. Which metrics are most appropriate to measure outcome related to compensation? Metrics correlation analysis examines the strength of the relationship between various metrics, for example, net income growth, EBIT margin, ROE, etc., and outcome, which can be measured as TSR, enterprise value, market to book, etc. The stronger the correlation, or R squared, based on regression analysis, the stronger the relationship between that particular metric and enterprise performance.
So a simple question that Mike, directors could ask management or their consultant is, are our current metrics that we use in our incentive programs, are they correlated with shareholder value or enterprise value creation?
Absolutely.
And just to tee that up.
I mean, this is a great way, again, to re-examine or to validate metrics that have been used or recycled over many years. And you may discover that metrics that you're using aren't relevant anymore, or a combination of metrics might make more sense.
Mike, I actually think that's a good point, because you can also test the correlation of combination of metrics. So the combination of revenue growth and ROIC, does that have a higher correlation than revenue growth on its own, or some other forms of combination of metrics?
Yeah, and the implication could also be, a difference in weighting.
And also whether it's measured over a shorter term period, right? Some metrics have a higher correlation on an annual basis, whereas other metrics have a higher correlation on a 3 to 5 year basis. That can inform whether you put it in the STI or the LTI program.
I guess that takes us to the next slide, our second analysis. And the second one here is called probability of achievement analysis. If correlation analysis is about the link between strategy and outcome, then probability analysis is about the link between outcome and measurement. Given that we have the right metrics, how do we know that the goals we've chosen, the level of difficulty, is right? Probability of achievement is all about calibration. It's about pressure testing performance goals. Are they too hard, too easy? Based on historic and peer performance, we examine the likelihood of achieving various levels of performance going forward, and that informs threshold, target, maximum payouts, or the payout curve. This is an analysis that's helpful if you feel that management is missing targets more frequently than expected, or the reverse, that they're achieved too easily. It's a lucid and compelling validation tool, great to have in your back pocket.
I would also say that, and we've seen this in the past years, that ISS has recently been focusing a little bit more scrutiny and attention on the rigor or the degree of difficulty of performance goals. And that tends to pop up if there's a disconnect between how they look at performance and the percent of target that companies been paying out at in recent years. So I think that this can be helpful from that perspective in examining the degree of difficulty and the rigor of the goals. And not just the goals themselves, but also, as Mike said, the payout slope, the rigor built into the threshold, the rigor built into the maximum, and how that slope is calibrated.
So I think it's time now for our third polling question. Pull that up. Here, okay. When reviewing compensation, directors' time is spent mostly assessing metrics or assessing goals. Any predictions?
Well, I don't want to bias our participants, but I would expect. Performance goals certainly at the board level, right? So the board spends a lot of time talking about the budget, the business strategy, the goals that underlie that. I think probably less time on the slope, so the threshold and the maximum, the range around target, but certainly a lot of time on the target. But I would have to predict metrics would get the heavier weighting.
Well, let's see what the results are.
Oh wow!
Okay,
Surprise!
wow,
Performance goals. Okay. Well, I started talking about performance goals first, so I think I biased the audience.
Well, it's good to see that there's a healthy mix here. I guess what potentially was missing from this is an option C.
Right.
Well,
we were trying to draw some distinction between the two, but I'm sure the director spent ample time, on both. But I was trying to see the difference between the two.
If there was a third option, it's neither. It's too much time spent on discussions around target versus actual, or changes year over year, or are we talking about design stuff?
Right.
Performance goals, performance targets. Great stuff. All right, let's move on to the next slide. Okay, great. So finally, I guess this brings us to P for P, or pay for performance. And we talked about analyses already that examine strategy and outcome and measurement. And P for P really is about performance, measurement, and pay. So this 2x2 matrix here is it's a literal visualization of pay and performance alignment. Along the vertical axis is compensation earned versus peers, or realizable pay. Along the horizontal axis is performance ranking versus peers. And performance is often at the enterprise level and for a period commensurate to that of your plans. Performance can also be measured as a composite if your incentive plans use more than one metric. Mapping pay for performance on the chart, we see here that there is a strong alignment for areas that are shaded in blue, the alignment corridor, and weak alignment for the unshaded areas. And you also get to see how your peers stack up, which is interesting. P for P really does close the line of sight between compensation and business strategy. So to quickly review, there are some important and compelling validation tools you can use to supplement your judgment. Each with its own targeted analysis. Used individually or together, you'll gain a more informed sense of pay and strategy alignment in your review process. That takes us to our next slide.
Okay, so this is Steve. So let's talk about process a little bit, from a director, committee member standpoint. As we said at the beginning, consistent with strategy, pay must adapt to a rapidly changing and ever uncertain environment. So that involves some flux, that involves some change, and some adaptation. Just from a committee process standpoint, and Mike started alluding to this in terms of using various tools at certain points in time to evaluate the efficacy of your program design or to assist with new program design. I think from a committee process, best practice is to ensure that the committee calendar, the annual calendar and the cadence of meetings allows for ample time to consider program design for the coming year. And I think that begins right in the first quarter after you've just finished the prior year. I think one of the things you can do is, the first thing you can do is actually take a look back at the year that's just been completed and use some of the tools that Mike spoke about, in particular the pay for performance analysis, to examine to the extent, the degree to which your pay that was actually delivered is aligned with your performance, and to the extent there are any gaps that can inform design on a go-forward basis. Also looking at the rigor of your performance goals as well. I think early in the year is also a time to have your consultants share with you and discuss market practices and trends. Again, this is not going to be the driver of your design, but it can help inform design to understand where the market is from a baseline standpoint and where the market may be going in the future. And then beginning, for calendar year companies in the summer or the Q3, to begin to discuss and consider program designs for the coming year. Alternatives considered, use that value driver mapping tool to understand the overlap and consistency of your proposed program designs with what your strategy is for the coming year or coming period of time. And that allows ample time leading into Q4, end of year, beginning of year, for the committee to give a final review and approve the program design. So it really starts at the beginning of the year, and it's a continual process throughout the year. And as you can see in this slide, this is just kind of a visual way to look at that process, but it does involve not only potentially revising programs, but just kind of reconfirming that what you have still makes sense from a design standpoint, and that it's still supportive of where you're trying to go as an organization. Okay, so that covers the content of our presentation. We have allowed a bit of time for some Q&A.
Before we move on to questions, let me turn the program back to Renelle Perry to go through a few additional compensation resources, and then we'll move to questions.
Great. Thank you, Richard. Please join NACD and Pearl Myers and Partners for our next program on compensation. It will be Board Review, What's Next for Director Compensation, and you can register on our website at nacdonline.com/webinars. And if you have any questions about our fellowship program, please reach out to Megan Metzbauer, Senior Fellowship Manager, at the contact information on the slide. You can also learn more about NACD fellowships on our website. Richard, back to you.
Thanks, Renelle. We have a number of questions, gentlemen, and let me start off by saying that any questions that have been submitted that do not get answered during the wind-up of our presentation, you will receive that answer later on directly from the participants. So the first question, is the metrics correlation analysis based on company-specific data or peer group or general survey analysis?
That's a good question. Survey correlation or the metrics correlation analysis is typically based on company-specific metrics, although analysis can be done with peers to see how you're competitively positioned.
Yeah, and to that point of using different market reference points, you could actually examine companies outside of your peer group to see where correlations exist there. let's say you're changing your business strategy to pursue more customer intimacy, and you want to see, companies that are excellent from a customer intimacy standpoint, what metrics are highly correlated with enterprise value in that space, and that can help inform. So it's not necessarily a static look at your company or your existing set of peers, but it can also be used in a more dynamic basis based on where you're going from a business standpoint.
Great. Next question. To what extent should we base an LTI grant, the grant not payout, on recent performance against financial metric goals?
Yeah, that's a very good question. One that I do come across from time to time. I tend to view that future grants as reflective of future performance. So you earn that. The grant is competitively sized, but you earn it in the future based on demonstrated results and performance outcomes in the future. So the grant itself doesn't necessarily flex based on prior performance considerations. However, I gave you an example of a company that did just that when we went through the slide deck. Where I tend to see it effectively used is not with stock options or performance shares. So those are more about future performance, but with time-based restricted shares. And the example I shared is the company did flex the number of shares in relation to past performance. So and that past performance in the example I gave were more strategic metrics, but it could be financial performance. It could be share price performance. I think there's an opportunity to do more from an individual and strategic performance standpoint with time-based restricted shares. But as a general matter, if your performance plan itself is inherently based on forward-looking performance measures, then I think that the grant size should be based just on market values. Good question.
Very good. Next question. There are several questions, in fact, that have come through that are in pretty much the same territory. What is a performance share? Is it in the form of an option or RSU or something entirely different?
Yeah, so when I say performance share, and I think I may have mentioned that a couple times, it's really a contingent opportunity to earn a number of shares in the future based on attainment of pre-established performance goals. So you may have a target opportunity to earn, say, 1,000 shares based on attainment of a 10% EPS growth goal or relative TSR at the median of the peer group. But you could earn, at the end of that period, fewer or more shares depending on the degree of attainment of that goal. So if you come in at the 75th percentile, you may earn 150% of those shares. When I use the term performance shares, it tends to refer to full value shares. Performance options would be a different vehicle. That's where you have a performance condition attached to a stock option. And also performance RSUs would be also a different vehicle. Performance RSUs tend to be not have upside opportunity, whereas a performance share does have upside opportunity. A performance RSU grant is a grant of shares or units, and you can earn all or a lesser amount of those shares based on attainment of a pre-established goal.
Sort of in the same territory, please comment upon ISS focus on performance shares rather than traditional stock options, etc.
Yeah, I've been on a panel with some ISS folks, and they always say that because kind of the typical understanding is that ISS does not view stock options as performance-based. That's always been my understanding. They've disputed that, and they say in the right situation they do view them as performance-based. But that hasn't been what I've found in companies that I've worked with and some of the reports that I've seen, where they do penalize companies for having options as not performance-based. I disagree with that notion. I think options are performance-based. I don't know how you can cast stock options in the same light or bucket as time-based restricted shares. If the stock price falls, you always have value associated with restricted shares, whereas options, to the extent they go underwater, they're at that present time, they're not worth anything. I think where they have concern is that participants in a stock option program can benefit from a rising tide effect. So to the extent the overall market is appreciating, options go in the money and you're benefiting from that appreciation. so it's not done on a relative basis. There are no financial performance conditions. I would argue that shareholders are also benefiting to that same extent. I think options can be a very effective vehicle, but I think they can be balanced effectively with performance shares and even time-based restricted stock in the right situation. But a good question, and one that I don't think there's a lot of clarity from ISS on.
Thank you. Next question, a very interesting one, changing topics pretty dramatically. Can you share a solution that you've seen with privately and or family-held companies aligning LTI with strategy and shareholders when the shares are thinly traded and determining stock value is more subjective than public companies?
Yeah, I find with my privately held clients, family-owned clients, that I think that stock can be used as a recognition and retention device to promote a connection to the company. But from an incentive alignment standpoint, to align incentives with business value drivers and business strategy, I think it's less effective. I see performance cash, long-term cash programs, or performance unit programs be more effective. Where you set a multi-year goal linked to certain desired performance outcomes, and then you deliver that and denominate and deliver that payment in cash. Performance units is just a slightly more complex and slightly more robust approach for private companies, where you have both the number of units and the value of the unit. And in that case, you can consider both lead and lag metrics with units. The lag metric could be the value of those units could reflect, say, EBITDA or operating income growth or revenue growth. That can determine the value. But the number of units that you ultimately receive, that could be based on more strategic measures. Key strategic priorities or imperatives that an organization can have that can result in flexing the number of units that are actually earned. Not stock units. These are units that are cash-based, but you use a number so as to allow for a more robust determination and alignment.
Thank you. With regard to discretion and what I interpret as subjectively adjusting incentive levels, what is a range up or down, percentage range you suggest so that you have some limit to the subjective modification?
Yeah, I think it's. I think in my experience, boards struggle with providing negative, having negative discretion. Taking incentives down, using discretion, and they're more likely to use it up. So I think the concern is if you have a discretion component to your incentive program, that there may be pressure, stated or more likely not stated, to upward adjust incentive outcomes to reflect non-financial results. We didn't hit our target, but yet we still we were operating in a difficult environment, or we had these types of headwinds that we were dealing with, and they don't expect the other way to work with when there are tailwinds. So I think that's one point of caution. And to the extent that you do consider discretion and it's your first time at it, I would start small and build from there. So plus or minus 10% as a type of modifier to a financially derived incentive. But the most important aspect of this is to not wait until the end of the year to communicate expectations around discretion. The ability to use discretion and the factors that would be considered should be identified and outlined at the beginning of the year, so that management clearly understands what they're going to be evaluated against at the end of the year. So let's say, cybersecurity, IT security is a big thing that boards are dealing with right now. And if there's certain improvements that board expects management to make in that area, those should be outlined and crystallized at the beginning of the year. You may not be able to set quantitative or entirely objective goals, or maybe subjectivity to it, but that at the end of the day is the board's job to evaluate the degree to which they improved and made progress with respect to IT security in this case. And that discretion can go up or down. And as you get more comfortable with it, then plus or minus 20%, I think is a more typical adjustment factor.
Yeah, Steve, Greg, I would just add there that before the comp committee or the board approve discretion, actually approve it, they ought to write down exactly how they're going to explain it in the proxy.
Very good point, Greg. Very good point. And
Excellent
potential
point.
for exposure there from an ISS standpoint too. So
right.
That needs to be crystal. It can actually turn to a positive, but you're right. It could also be a negative. So you got to get that right, Greg.
It will crystallize it.
Yep.
Going on to the next question, is using the same financial metric for both STI and LTI plan design considered flawed plan design?
Not necessarily, because you could argue that, let's say that you test operating income growth and you find there's a high degree of alignment or correlation with operating income growth, both in the short term and in the long term with enterprise value creation. That could be the case for having that as a metric in both programs. It also motivates and rewards sustained performance in that metric. So yes, you have to deliver the result in 1 year, but then you can't just rest on your laurels. You need to deliver that level in that metric on an ongoing basis. And so that could be a case for having it both the short term and long term. So it's not necessarily flawed. Is it ideal? It depends on each individual's organization's kind of unique profile and circumstances. I would say that to the extent that you can build in dynamic tension across your incentive platform in the short term and long term, that's going to create a more dynamic profile and more robust measurement system for the company. So you encourage short-term, behaviors and actions and outcomes that in turn are going to drive long-term value creation. An example of that would be revenue growth in the short term, if that's identified as a key strategic priority and a value generator. But at the end of the day, you want to hold folks accountable for making sure that, let's say they drive revenue growth through new product introductions or acquisitions. Ultimately, you want to be earning those investments should generate returns above the cost of capital it took to make those investments. So ROIC rather than revenue growth may be a better long-term metric to create that dynamic tension or check and balance. So I guess the short answer, Richard, is it depends.
Yeah, and Steve, I think the critics always say you pay twice for the same result and the same metric. And there are a lot of metrics out there. There are a lot of metrics out there, and I'm sure Wall Street or the investors look at more than one at times.
Sure.
Well said. Gentlemen, I note that we are now out of time. There are a few questions that remain unanswered, so they will be coming to the people who submitted them in the near term. I want to thank everyone for their participation. It was an interesting session, and I think everyone got a lot out of it. Thanks much.